You can't replace part of the brain. Like, you
treat them the same.
The source of truth for the medtech industry.
Coexists with the prophets.
Robot understands things automatically.
#1 show in the medtech industry.
So Stryker got ahead of that and changed in the 90s, built $1 billion company that held up high. A lot of things.
State of medtech with your host, Omar and Khateeb.
Hey everybody, welcome back to the show. I'm so excited about today's guest because he's somebody who I have a tremendous amount of respect for, not only as an author, but more importantly, a practitioner of what he does, and that's Orrin Klaff. Orrin, best way to describe him is he's somebody who is an investor, he's a company builder, and has deep experience in the capital markets as an insider, and he has 2 best-selling books. One is Pitch Anything, the other one is Flip the Script. Essentially, if you're a founder, if you're a salesperson, really anybody who's working in the world of business, I highly recommend the books. I have the book that I originally purchased back in 2016, which is Pitch Anything. This book literally paved my way into Silicon Valley and is a staple of my persuasion frameworks. So in this episode, Oren and I talk about the game of money, which is his latest webinar. More importantly, he's fundraising for a fascinating project for a company, $200 million plus project. And if you're an accredited investor, I highly recommend you check this out. The way you can learn about this deal is by checking the show notes below and clicking and watching the webinar, which kind of goes into details about it. Even if you're a non-accredited investor, I believe there's an equity crowdfunding option for you. In any case, I do recommend going and watching that webinar. So check the show notes below. Or if you're driving, go to, once you're stopped driving, go to his website, ORENKLAFF.com, and click on webinars and you'll see that webinar there. So in this episode, we covered the game of money, fundraising today, along with a lot of other great topics around persuasion and more. We did this in Orrin's beautiful and probably the coolest studio that I've been in, down in Carlsbad. I'm very grateful to call Orrin a friend. More importantly, we share the same values, as family men, as leaders in our communities. So with that being said, enjoy our episode with the great and powerful Orrin Klaff. Enjoy. What's going on, everybody? Welcome back to the show. I'm really excited for today's guest. And as you probably noticed, I'm not in my home studio. I'm in the beautiful studio and offices of Orrin Klaff. Many of you know who Orrin Klaff is. For those of you who, for some reason, don't, let me give you a little bit of an introduction. Orrin Klaff is a deal maker. He's also an author. I was introduced to Orrin's work many years ago in his first book called Pitch Anything, which essentially is a guide to persuade anybody and pitch. Unlike a lot of the persuasion books I've read in the past, again, if you follow the show, you know how much we love persuasion. A lot of persuasion books are written based on research and hypotheses, etc., and not a lot of real-world practical applications. What I loved about Orrin's work is that it was actual real-world applications that he lived out. He went on to write a second book called Flip the Script about deal making, same quality. And I remember messaging him earlier this year, and I said, Orrin, I was walking along and just reading your book, and I said, damn it, this guy's done it again. And so I wanted to have him on the show, wanted to talk about what's going on in the markets, because outside of being a successful author, he is a deal maker. He's involved with the markets and the investment capacity, but also just talk about a lot of things around persuasion and many other things. Orrin, thank you so much for coming on the show.
I appreciate you coming here, and let's kick the tires and light the fires.
Absolutely, absolutely. So maybe a good place to start is with Pitch Anything and Flip the Script. What was the motivation behind those books, and then how's that translating to what your business is today?
Yeah, great. So I think the way I got into Pitch Anything, as I tell in the book, is not, hey, I need to write a book. I lived these things, like I was raising a lot of money compared to, and we're doing it again, by the way, here as well, like with a few people doing something that people didn't know or understand or couldn't see from the outside. We were raising more money than larger groups or multi-unit divisions. And so just me and my partner were raising tons of money, and people were like, how are you doing it? And I'm like, I don't have any secrets. I'm happy to tell. Like, I wasn't part of there wasn't Instagram. There wasn't hey, buy my course. There was no paywall. And so I got passed around to a couple different publishers, and then McGraw-Hill said, we love this, and I'll write a book on it. And so what I realized was that just because you know how to read books does not mean you know how to write books. So
it's a great point. It's like starting a restaurant. Just because you know what good food is doesn't mean you should open a restaurant.
Yes.
Funny thing I have to tell you about that book is that book actually is the reason I was able to land a job, my first job out in Silicon Valley, and literally a job that was created out of thin air.
I'll tell you about that story off air, but yeah, thank you for writing that book.
So what happened to me and what triggered it, we were in a deal with my partner. I didn't write about this one in the book, but the deal was going well until it wasn't, like all deals. And we were one of the counterparty to wire. We'd done everything that from our side. We're just waiting for them to wire, close, make our money, everybody get their shares. It was a real estate deal, and then we all move on. And they were not wiring. This is another one that I really needed to close. We've been in for a long time. My partner was super wealthy, and I needed the money from these deals to close. I hear bing, back and forth going on. They were not signing the paperwork, and they weren't wiring. And then my partner, Russell, at the time, I saw in the subject line, all caps, 3 words, lose my number. Nothing else in the email. Like we're 3 months into a deal with 2,000 emails back and forth. And then one email, lose my number, from my partner to the investors. And I just slump in my chair and I go, it's done, because in my reality and my version of the world, like nobody sends an email like that where I came from. Like institutional finance, classic education and finance, like you would never send it. Like it just boggles the mind. And so I'm like, this deal is done. We're going to find someone, sell some stuff or figure out how to survive. No money is coming. And so I just slumped in my chair, and 4 minutes later I hear bing. Like this was before Gmail was really popular, and you still have Microsoft Mail, Outlook, and you know, would ping every time an email would come and go ping. And I'm like, oh my God, here's all the hate mail, and you lose our number. And the email comes through, and one of them says, so sorry. I know we've been dragging our feet and everything. All the paperwork's cleared. We'll wire this afternoon. And I was like, what in the world just happened? You know, something that I don't understand occurred. And so the more I hung out with that guy, the more deals we did, he just showed me an upside down world where you didn't have to, you know, his mantra was, I'd rather die on my feet than live on my knees. I'd rather die on my feet than live on my knees. And so he never bowed down to anybody. And sometimes deal didn't close, but he said, we'll just write the check and we'll eat it, but we hold our heads high. So when I adopted that and then turned it into a sales strategy, and I wrote about it in the book, everybody's, oh, I resonate with this. I don't like supplicating to buyers, investors, 100%. Deal making. I don't like people saying, hey, we're gonna wire on Wednesday, and then Friday not answering your email, and then just going, hey, just checking in, how are you? I don't like people saying, hey, I'll sign the paperwork, and then they don't. And then you're having to say, is there anything I can do to help you? I don't like people saying that they are going to come to a meeting with their team, and then just one like junior person shows up, and you go, let me tell it to you, and then you can share it with your team, or we can record it. You go, hey, get your team organized, but if you're not the kind of people that can show up organized and do what you say, I don't want to work with you. And not as a frame or a game or a tactic, but actually, or a strategy even, but actually as a way of living.
100%. And it's interesting you say that, because your book is part of a small collection of books that I often recommend to new mentees and proteges. And I was talking to somebody about it probably a couple of weeks ago, and they were mentioning the tactics and everything. And I was like, hey, look, what you have to understand is underlying all this isn't a tactic or a hack. This is about living out of values. Like when you push somebody on meeting certain expectations, if you're going to take time to prepare for learning about, let's say, somebody's company, and they don't reciprocate that, this is not a tactic. This is a value where, hey, if you're not going to reciprocate those values, you're not somebody I want to do business with. So
the values is very confusing topic, you know, now that we're into it. So if I have people here at an event and I go, you know, pick somebody out and I tell me your values, what they will do is just start to read me the Bible, right? Don't covet your neighbor's wife, tithe your earnings, be good to people, do unto others as others do unto you. And they'll just list the 10 commandments and expand that. No, not what are the ordained values. What are your values? What makes you mad? So for example, we know as a value, you shouldn't lie to people, but lying for me, people lie to me all the time. I work in finance, right? And sometimes they have to, sometimes they go too far. It's part of gamesmanship. Sometimes gamesmanship turns into gray area. Sometimes gray area turns into non-compliant behavior. But people lie to me all day long. It just doesn't trigger me. Other people, they get lied to, it sends them over the top. Maybe they had a girlfriend cheat on them or whatever, right? So your values are your center pole, and they're what you have. And so the way I think that you really do sales is you have a set of values that you stick to, that are reasonable, that are true, that are part of who you are, and you actually live them. So what good is that? Well, what good is it is now you are able to have lots of control over the environment. Because when somebody behaves outside of your value system, you can just call it out, right? And now you can start to have frame control. I always look for something, for example, for me, time is a value with a lot of people. I show up on time, I show up prepared, and with the work I'm supposed to do. So I go to calls with guys with billion-dollar family offices, actual billionaires, billion-dollar funds, $100 million funds, guys with managing $150 million of their own money. I show up on time, or one of our team shows up on time. We start the call, and then now all of a sudden it's 2:04, and they pop on. And I go, hey, Jim, you here for the 2:04 call? Right? Now, you might not be able to pull that off. I suspect you could, but because my value is time, I can pull it. And they go, and just so happens that billionaire, 100 millionaire, $1 values time. Like in our American culture and society, like everything is set to a clock, and we value people's time. Even if you're a golf valet, when you're a billionaire, that is one thing that you guys have in common is time. So I say this, hey, are you here for the 2:04 call? And they're like, oh, I'm so sorry. I'm like, now we started the call correctly. You apologizing to me, not me begging for your business.
And saying, oh, thank you for taking time out of your busy schedule, yada, yada, yada. Completely agree.
Correct.
I completely agree with that.
So values are a way to establish that you, as a buyer and the investor, do not lord over me. You do not control this environment. You're not better than me. You're not worse than me. We are peers. And so the problem with selling, I'd be interested to have your opinion on that, is the guys with the money to write the check believe they are superior to you. When somebody believes they are higher status than you, you're superior, three things happen. Number one, they view you transactionally, not as a relationship, not as something to build. Just what can I get here at this table that's good for me? Number two, they take risks around you that they would not take around their peers. For example, as I've said many times, you go to Bank of America on a $100 million decision on some construction debt, and it's like the decision meeting, when the phone rings, right? You're like, oh my God, how did I even leave this on? Oh, it's my mom and her house is on fire. I'll have to call her back, right? You would not answer that. But maybe you were hiring a receptionist or something, your phone calls and it's the pool guy going, hey, how much chlorine should I add? And you're like, hold on, I got to take this. So you act differently around people that you believe you are superior to, and you take risks around them. And then the third thing is that they view you superficially, not as a person, as a family man, as a community member, as a churchgoer, as somebody involved in things outside of work. So they view you superficially, not about your character. They don't see any of your character. They view you transactionally. How much can I get cash on the barrelhead right now? And they take risks around you they wouldn't take around their peers if they perceive you as low status. So that is why the number one route to being a low status person is having limited or no values or lack of clarity around what you stand for.
I couldn't agree more with you. And I think what you said is just, it goes beyond business and sales, it goes into life, which I think, again, when I read your books, a lot of it is based on that, which is like, how do you have the right set of values? Because you can't, as I tell a lot of young sales reps, you can't put on an act. This is why you should only sell a product you actually believe in, that will actually help and you would actually use. Because if you don't, then like you've lowered your values there. Something I want to get into, we have a lot of investors who listen to this show. You had a fantastic webinar, which I'm happy that you said you'll come on our show and do that webinar, which is the game of money.
Yeah.
And you focused on a third pathway, which is where you can invest. I loved your point about get rich crazy, which is a lot of like angel investing, seed capital and everything, which is fine, but you're expecting 1,000x return. And there's the later stage, which you have to be a banker, Goldman Sachs, JP Morgan, et cetera. You can't play that game. But there's something in the middle where you get like a nice 3 to 4x return that you said you've learned that people who've made a lot of money in family offices, billionaires, et cetera, that's where they play. For the investors who are listening, like, what has changed in the market? Because the last 5 years has been nuts.
Here's what happened that's really interesting to me is get rich crazy. In 2019, 2020, 2021 worked. So crazy worked.
Can you give our audience an example of what that looks like?
So you could go out, go out on a Wednesday night, go drinking with your buddies, get home at 1 in the morning, fall asleep, wake up at 10 o'clock and go, I don't have a job. I got to make some money today. You get on online and you can buy a Michael Jordan rookie card, right? Do some searching around, find one, buy a Michael Jordan rookie card, and know that 2 weeks from now, you're going to sell that Michael Jordan rookie card for $10,000 more. And so you end that day up knowing that you made money because these are rising value assets. And there's always, so that's a trade. So I think about investing is different. I think about it as a trade, even if you're investing in a company. Trade in, something happens, trade out on a particular timeline. So in that trade of buying a Michael Jordan rookie card, then your day was over because you got access to an asset in which there's always somebody to the right down the road in time willing to take that asset off your hand for a larger price.
Maybe even a digital picture of a monkey.
A digital picture of a monkey, right? So bathing ape or whatever it is. So that car right there, we don't have to say what it is. Like I bought it. I had a deal with the company. We did some. They traded my fees for the car. I got the car. But in 2020, so in 2021, I'd driven the car for 4,000 or 5,000 miles, and it was worth like $450,000. Right when I bought it, it was like $350,000. So I drove it, and it was worth more 3 years later than I paid for it. That is that everything is moving up and to the right. So Get Rich Crazy worked, where you could go into things that were exceedingly risky that a normal investor would not go into. That's why it's available, right? With high confidence that just because you got your hands around the asset, whether it was CBD, like a CBD company, whether it was a hard seltzer company, whether it was you could invest in a new beer, one of thousands of upstart beer companies, anything on the blockchain, anything in Bitcoin, anything memorabilia, anything automotive. Certainly we can talk about it later, anything real estate. And that thing was going to be worth more at the end of the week, at the end of the month, at the end of the quarter. And that became an institutionalized thing. And it started sucking in people like, no matter what I get my hands on, I'm going to make money. And that became Get Rich Crazy. So now all these assets in which you needed professionals to invest in, startups, biotech companies, blockchain companies, software companies, web companies, e-commerce companies, and then now you started seeing like barbecue companies with blockchain and software connections and all this crazy stuff that needed a professional, crazy investor to invest in, got down to the masses. And so Get Rich Crazy became a thing that worked for a while. And then the everything bubble ended. The game stopped, the pandemic money dried up, and people started losing money, and not everything worked. Now you had to go back to actual strategies. And so what happened is people don't, but there's still this lingering, in America, we always want to fight the last war. Like we don't get our heads ahead of it and be like, how do we fight the next war? We lumber giant tanks and howitzers and troops, to wars that are being fought in a guerrilla style. Like we always do the last thing economically or in wars that we did before. And so we largely in the US, what people became familiar with was tech investing and real estate investing. And so when that stopped working, what happened is people said, I just have to find a different kind of tech deal and a different kind of real estate deal, because there was so much exposure to where you had everybody was either a realtor in real estate or in some form of tech investing.
You think it was a sunk loss fallacy that people were just like, I just have to find a different angle here?
Correct. I don't know how sunk loss fallacy transliterates over to this is what I know, because it was so easy for you who knew nothing, right? If you were a doctor, if you were a professional, you could come home and get your feet wet. You get over your skis. It was easy to get into stuff.
It's like drugs, right? People just got used to easy money, and
easy money.
It's very difficult to let go of easy money and say, oh, I have to actually put in work now.
But I think the thing is, like, people got success in an area that normally would have been shut off for them. Investing. So we can fast forward today in the game of money. I don't know if people have really met a Harvard University, Yale University, USC, Stanford, Dartmouth, even University of Delaware, graduate in finance with a 4.0, right? With 2 years of experience on Wall Street. These kids or these people or these men and women are so smart, are so meticulous, are so well-informed. If you see 4 or 5 of them working on a project and what they're going back and forth with on Slack and how much they're based on data and numbers and market-driven and how hard they work, how sophisticated their modeling and finance experience is, how well they understand securities and compliance, you would be very scared seeing those guys work. And those guys have money, so they're in a firm, they're working together, they're working 10 hours a day, 7 days a week to do what? Find deals. So they're in a firm that has money, they're in a firm that has a thesis, They have real finance degrees, and they're guided by managers who have really spent a career in the capital markets. And today, if you're investing, you're going to come up against that.
You're not going to be that.
And you're going to lose.
Not to mention the tools that they have at their disposal.
The tools that they have. And I helped fund a deal by a guy who came out of a trading firm. So if you read about the guy who came out of FTX.
Mr. Sam Bankman-Fried.
Right. So basically that firm or one of the competing firms that he worked. So a guy was basically a Sam Friedman in one of those other firms. He made $60 million. He came out and he hired 10 PhD physicists to work in algorithmic trading formulas in Manhattan with a short fiber optic cable to NASDAQ so they could make quick trades and really doing trading analysis. And he had $60 million. Now you are going to go, hey, I'm going to do some day trading. There's like a chimpanzee going, I'm going to challenge Gordon Ramsay to a baking contest. You're just going, hoo, hoo, hoo. I'm going to do some day trading in EV. You are their product. When you make a trade, the professionals are sucking up your money and trading you back a loss today. So my point is, in investing, now you have professionals just like the Eye of Sauron looking for real deals and sucking up the 4X, the 3X, 4X, 5X return deals and leave. I can tell you this, today, if you think you're an investor in real estate or in technology the way it was, 2021, 2022, and you're looking at a deal, that deal came out of the ugly tree and it hit every branch on the way down. It landed on the sidewalk. And here you are in wherever you are, Scottsdale, Arizona, Gilbert, Arizona, Bangor, Maine, Destin, Florida, Daytona Beach, Florida, and you stumble across this deal. They're like, oh, this looks pretty good. That deal, every firm of any merit has looked at that deal and said, pass. But because you're not a real investor, you're like, this looks pretty good. And because you were trained on the last models, real estate tech, and the way I know somebody's not really an investor, we talk about it in the thing, like, what do you need to be an investor? You need access to deals that are at your punching weight. Number two, you need the ability to underwrite deals. So you need quantitative analysis. And number three, you need deals that would take your check size. And the chance that you are in, where did you move here from Florida?
From Orlando, Florida.
Orlando, yeah.
But I'm from Texas.
Texas. Where in Texas?
El Paso, Texas.
El Paso, okay. That's funny. We almost moved to El Paso.
Really?
Yeah. My dad had a job there at the University of El Paso. The chance that you're walking around El Paso, Texas, and you find a tech deal
that somehow everyone's missed.
That everyone from Silicon Valley over to Boston, through Manhattan, down through Chicago, even around Austin, maybe through Dallas, and everybody else have been like, well, I don't know how to, analyze it. And it's a small check size deal, so then it can take your $250,000 or $50,000, and everybody else whose job it is, they have AI, software, data, tools, smart people working on it. I'm gonna let this one pass. It's gonna land in your lap, and you get that 100x winner. Chances of that are pure Brownian motion, pure random. Give you an example. Sorry, I'm talking a lot, but I just want to share this with you.
Hey, you're the guest on my show. People want to hear from you.
I helped fund a fund, affectionately called Black Swan Capital, but it's Right Side Capital. And they came up and they said, look, we have to put out 146 investments to get one alpha return. So now what they did is in order to be able to put out 146 investments, they go, well, we need a way to put that out because that's a huge amount of underwriting. So they just said, listen, if you can fog a mirror, if you came from a company, if you have a partner, so you have a technical founder, and you came from a company in which you left a real salary behind, because they consider that kind of a proxy for investment, we'll give you whatever it is, so just $250,000. We'll just give it to you. We'll glance at the business plan, right? But as long as it's something towards a high efficiency business model, which is code for tech, we'll give you the money. Because they got to get that $250,000 out 146 times. So you as an investor in get-rich-crazy deals, whether it's CBD, whether it's blockchain, whether it's tech, whether it's e-commerce, whether it's space travel or space tourism or EV or new batteries or pharmaceutical, but early stage, you as an investor very likely don't have the capacity to get $50,000 out 146 times in a row. So you can't get at the alpha, even if you had the skills to evaluate what alpha is from El Paso, Texas. So these are the challenges that investors have today, is there's professionals who are looking at the real deals and sucking them up. And so it's this huge quagmire, like so then what happens is, and this may be your next point, so if you're not, people get cured today of get rich crazy because it doesn't work, they lose their money. And there's still like hope springs eternal, this is gonna be the next Tesla. But like, this is another topic, like why, and then if I'm gonna play a game for the first time, right, a video game, I'm gonna, like, life as a video game has so many parallels. I don't know if you play video games.
Oh, yeah. I grew up playing
There's so many
video games,
parallels. Yeah. But Jesus, don't put it in nightmare mode.
Yeah.
Right? Like, hey, I'm going to learn this game. Everyone wants to skip over that learner part where you learn to fire and spin and how to reload
go straight
the
to
weapon.
Advanced mode.
Just go straight to nightmare
idea.
mode, right? And so the problem is everybody hates playing with that guy who's playing the game at too high a level. Because we go, hey, Omar, come join us. And you're like, yeah. And like, you have no reputation in the game, so you have no health, no weapons, no experience. Hey, Omar, we're going to go take this. We're going to stack up and go take down this enemy stronghold. Boom. Where's Omar? Oh, he's respawning. Okay, we have to wait. You have no health, so one bullet hit you. Why is Omar carrying around a knife? Well, he doesn't have any weapons, right? What is he doing here? Like, now we have to basically get Omar some health. We got to get Omar weapons because he's not able to take care of himself. Like, you have to play the game at the level that makes sense for you. Everybody wants to jump in the game of investing in nightmare mode.
Yeah, I feel that Wall Street Bets is a great example of this, is at the moment somebody has some money, let's say 100K and up, they immediately feel like they got some special gift. Maybe there's some Midas touch going on or something, and they want to just jump in and play a very difficult game. And as a result, they end up getting wiped out.
Sure, because what this world needs is a loser magazine, and every month of loser magazine there'll be 1,000 pages to the Forbes magazine, which is 60 pages. Not 1,000, there'll be 10,000 pages, but nobody circulates the losses because they're embarrassing. They have legal issues around them. They have compliance. Everybody circulates the wins, talks about the wins. So the wins have this psychological massive overexposure, right, that gives you a false set of confidence. But if you really got to see the losses at the scale that they occur, you will be terrified to invest, in anything that you don't have a lot of experience in. So, yeah, to your point, like, people get overconfident because they see somebody else who they think that they're smarter or more experienced or harder working with doing. So if they can do well, what one man can do, another man can do. So that is maybe the pure distillate of the success of humankind, right? So when we go, if one man can do it, another man can do it, and maybe better. But it also, in today's world, like, we're not in these physical environments all the time. So in today's world, that what's built into our psychology is if one man can do it, and I have the same tool, I have the same stick, I have the same fur, I have the same string, I can do it as well. That's what would lead us to hunt, to strike out, to explore, and everything like that. But these are much more complex environments in your ancestral mind can compute around, but you rush into them because you think somebody else can do it.
Yeah. I'm wondering, you mentioned, one of the first things you mentioned was finding investments that are at your punch weight, right? What does that mean?
Sure. So I think that's right.
Assume that also that this is for the investors who, there's some medtech founders who listen to the show who had an exit, and so they have a few mil in the bank now and stuff. And I feel like this is really a message for them, right? Or anybody who can write a 100K check size or above.
So I think that this goes back to where we started. There's a sense of, in my investing, so there's get rich crazy, right? Which I think we defined. It's like stepping into investments that ignoring that there's people who look for high quality investments have probably seen this, passed on it, and that's how it got to you.
And again, for those people who play in that world, for those who are listening, we're talking about mainly venture capital firms. They're deploying 100 of those checks, right, over a large portfolio, and they're looking for one or two to make up for all the losses of all the other ones. Versus you, like, you're looking to hit like a 1 of 1 home run, and it's just, let's say even if that does happen, the likelihood that you got the right terms of the deal in terms of like liquidation preferences, etc. If more money is raised, you'll get washed out. I actually, just to open up, that happened to me. A close friend of mine started a company. I thought it was great tech and everything. I wrote a check for 11K, right? They ended up selling a few years later, and my return was like $1,800. Even though I had preferred stock, it's because the investors that came later on had much better terms, and it washed me out.
That's right. So this is really what I mean by getting in a situation where you're taking punches above your weight class, right? So when you're going to mix professional investors and private investors, there was a show called Pros versus Joes. Did you ever see it?
Oh, that was a great show.
Great
Oh,
show.
that was a great show.
I think
for the art, tell them what Pros versus Joes is.
Pros versus Joes are a cool concept.
The physical challenges were my favorite ones because people just got obliterated.
These were physical challenges where they took retired but nearly retired professional athletes, football players, basketball players, right? And then they took weekend warriors, like good shape, who are not professionals, but they just play in like a summer league or a local football league. They're in shape, fast, young guys. So they put the pros versus the Joes. And like the Joes would beat you and I every day of the week, but they're not semi-pros or Joes. And so you see the Joe, and he's like in shape, he can run fast, he can catch the ball, he plays flag football, works out at the gym, a really great guy. And then the Joe is like retired, and he may not even have worked out in the last year. He's lumbering, and then they go run, they do a pass rush, or they do a physical challenge. And the retired, washed up pros completely decimate and crush 100% with no competitive gap at all, the Joes. They just win at everything. And so the show had 6 episodes because it wasn't a show.
We need like a business version of that today.
Yeah. So the professionals crush the amateurs. You cannot mix amateur investors, small balance investors, individual investors, and professional investors because the professionals are pros. They know what they're doing. They have the legal, they have the experience, they have the know-how, they can write the check size, and they can create the security that crushes every Joe beneath them. And why do they do that? Why do they put those cheat codes in deals? They do it. Why do they put liquidation preferences? Why do they put drag-along rights? Why do they put minority control provisions? And why do they put liquidate and the ability to flip the board and control the whole company, right? Or the main sort of cheat codes that perfect. But so why they do it, I'll talk about in a second. But one thing is 100% for sure is that professionals load deals. So if you are mixing pros and Joes, you are very likely on the Joes team and you're going to get crushed. The reason they do it is for 3 reasons. Number one, good reason, right? They're putting a lot of money in. You put in $100,000 in. Yeah, sorry you lost $100,000, but we're putting 10 million in. So like, too bad, right? But we want control. You can lose $100,000. We cannot lose 10 million. Like we'll get fired. So we need control because we're writing a big check size. So they do it for good reason. They do it for bad reason, right? Hey, we're putting in $1 million, right? But nobody knows how to look at these documents. I give an example in the webinar we'll do of Jessica Alba's company. She just didn't look at the documents, right? And she got a 2 times liquidation preference. It was horrible.
Can you please tell the audience about that? Because that was shocking.
And I'll just finish this thought and then
Oh,
I'll
yeah,
go
please.
through that.
Yeah, go for
so
it.
they do it for good reason, right? They do it for bad reason. And many times I see the documents, professionals load deals with toxicity that wipe you out and crush you for no reason, because they can, because nobody read the documents and they just use their normal documents and they got minority control, they got liquidation preferences, they got board flipping rights, they got drag-along rights, because nobody pushed back and they're like, fuck it, if I can get it, why not? Professionals, you cannot go into a deal where you're mixing all these investor classes and you're in the class that is the least amount of power, least amount of experience, least amount of money, and the least amount of actual legal control. So Jessica Alba is in a company called The Honest Company. We have these products in our house. Do you have the products in your house?
I have a couple of them, yeah.
So we get it. My wife likes them and everything like that. So it's worth a little bit more now, but the day I pulled the stock and did this analysis, The Honest Company was worth $104 million.
That's right, yeah.
You're thinking like, wow, Jessica Alba probably owns 30, 40% of the company. If she sold it today or she cashed out her shares, she'd have made $20, $30 million. That's pretty good for making some, I don't know, soap. Put your name on it. But if you really dig into the documents, which PitchBook did, they found out that 2 investors had $50 million in the company, right, at a 2 times liquidation preference. So they have a $100 million hurdle that has to be paid off. So if that company Honest Company was sold on that day for $104 million. That market cap was acquired. The investors will get $100 million.
And double their initial investment.
Double their initial investment, right? Which is a cheat code. It's pretty toxic. And Jessica Alba and friends would have gotten $4 million. Not a lot of money to.
Not a good day.
Not a good day for
pre-tax,
starting
etc.
a company, pre-tax, getting the company public, and then selling it. So and that's not like a one cherry-picked example. I can go through hundreds of examples, and a lot of the names you'd be familiar with. These liquidation preferences are really damaging. So said in another way, if you're an investor in a deal, your biggest risk is every other investor that comes in on top of you and the management's team's ability to raise capital or run that deal without having to take professional money, or being able to take professional money and have control over it and pushing back against those toxic terms. You're going to crush you, the Joe. So how can I get into deals where, even though I think it's a good deal, I have confidence that a professional is not going to come in here and load the deals up with this super high hurdle rate? And in order to ask that question, you have to understand what professional investors do. They raise money to go run a fund. So let's say they raise a small amount of money, $200 million, right? And so they're going to take that $200 million and they're going to put $12 million in 13 deals. So it's going to get rid of $13 million, another $5 million in operating costs, $140 million is gone, and they got $60 million in dry powder. So now they have, how many deals did I say? 10, 13? 10? 10 deals, whatever. Okay, so 10 deals in that math. And now they have this incredible optionality because they're running 10 deals. It's not like you are running your company. So you're running your company, and I go in and I go, hey, let's go do a Super Bowl ad. And then you're like, yeah, that sounds great. That could drive all kinds of traffic to us. We're local here in Southern California. People in Boston and Florida are going to see the ad. Is that really going to make sense to us? You're like, it's a Super Bowl. Let's do it. And you're like, great. And then I go, it's $1 million. And you go, you have lost your brain. Like, I am not spending $1 million on a 30-second ad. And so why are you saying that? Because you go, it's too risky. And so you make decisions about your own business that are safe. Yes, you want to grow. You have to risk reward. But your risks are like, hey, let's spend $10,000 on some like Instagram ads and see how it goes. So you moderate the risks that you take. You say, hey, we need to hire some people and grow. We need to open up a new clinic. You're like, okay, great. Let's open up one clinic and see how it goes. Let's hire 3 or 4 people for sales, see how they produce. You're taking risks, but you're mitigating it for like this comfort zone where you know you're reaching, you're competing, you're taking risks, but you are not going bananas. Go back to the private equity group or venture group that has made 10 investments. They know that 2 of those have to become super alphas, really perform. How do you get something to become a super alpha? You take risk. And so now they don't know, these are baby turtles running for the beach. And there's seagulls flying overhead. And they're coming in. You're like, they're not all going to make it. Like, we know they're not, right? But we know there's only so many seagulls and we got enough baby turtles. We know 2 usually make it from this egg hatching. Sure enough, the seagulls come down, but it's Brownian motion again. Like, you don't know, it's an actuarial table. You don't know which turtles are going to be eaten by the seagulls. 2 are going to make it, but you don't know which ones. So in the same way, like, the private equity group is going to spin the risk knob and tear it off. So follow me through. If you're a company, Jessica Alba or whatever, and you get invested in by that private equity group, right? Now you have one deal. That's Honest Company. That's your deal. Like, you want to do it. But now you're in a private equity group, and now you're completely at odds with them all the time because they want to take these risks that you view inordinately disproportionate to having a good company. But they don't want to, and they agree. Like, these are too high a risk to have a good company. But they don't want a good company. They want a super alpha. And so they spin the risk knob and tear it off. And that's how people end up with stories like yours, where they just went for gold, but they just didn't make it. Mm-hmm. And so they took all these financial risks. They loaded the deal up. The deal didn't hit the pro forma or the financial goals. But now because it couldn't be sold for $1 billion, which was the target valuation, anything below that valuation is underwater. But without running that model here, showing the spreadsheet, ultimately professionals load deals with risks that you wouldn't take in your own company.
On both sides of that coin, so then what's the game that you recommend investors who, and again, you actually wrote a great article for those who are interested. Your website is OrenKlaff.com, correct? Yeah. Really good articles on there. One of them was talking about that there's a lot of value in just writing 100K checks. I really like that a lot. And so that kind of opens up to this sort of middle ground, which in our world, in the medtech world, we have this place called no man's land where there are companies that are gone through FDA, maybe they're pre-commercial or slightly commercial, and then growth stage companies, and they're this no man land where nobody wants to touch them.
Right.
I think it might be a little bit different from the deals that you talk about, but talk about this area where, like, why go for the 3X, 4X deals?
Sure.
And what does that mean?
So the 10X or 100X or 1000X deals are loaded with too much risk.
And to get anything out of it, you got to deploy a lot of those.
Have a lot
you don't
of
have
money.
that money.
You have to have experience. So the other thing, we're getting long in the tooth here, but the unicorn factory is closed. So the unicorn factory worked like this, right? You didn't have to build a company. You could
be pre-revenue.
Sure.
Be worth
like,
more.
This is the same thing. Michael Jordan rookie card. You could have your job was to create a pre-revenue thing in which you had a beta, in which you had customers, in which you had a viability test. If it was a med tech, you had some proof of concept, or you had a device, you had a customer potential trial, customer evaluation, and you created something, right? And now you've got a $10, $12 million valuation on it. You got $1.5 million in, and that nobody in your company has the ability to take that and be like a public company or a profitable company. That's all. And then, so that's like in the unicorn factory, if this was a car factory, like you got the frame, you bolted together the chassis, right? You're like, hey, I'm not in the door department. I'm not in the engine department. I'm not in the roof department. I'm not in the interior department. I make chassis. So then you put it on the line, you get paid for doing your job, and it moved down, and then somebody puts the doors and the hoods on it in the next Series A part of the unicorn factory. But they don't know how to build a whole company. They don't know how to start the company, and they don't know how to get the company then into upholstery. They just know how to put the doors and body on. Then it moves down. The next part of the unicorn factory would put the engine in. And so you don't know how to start a company. You don't know how to put body on it. You only know how to drop the engine in. And you got paid for doing that, right? And successfully. And then it went to upholstery. Then it went to paint. Then it went to sales. And so everybody in the unicorn factory didn't know how to build a company. They only knew how to do one piece of it. And that thing, you can no longer be successful doing that. Now you have to build the entire company.
And you have to, I completely agree. And this is an issue in our industry right now, because it used to be even 15 years ago, you can just build a company to a certain point, even pre-FDA or right after FDA, and somebody will come and acquire you.
Right.
And those days are gone.
Yeah.
Because a lot of these large strategics want a bolt-on that works, which means that it's like a commercially viable vehicle. And some of my mentors who came out of the Missouri Robotics 10 years ago, is a company that got acquired. They taught me something very early on in my career, which is you don't build to get acquired. You build a company to last. And if you do it all the right way, that stuff will happen on its own.
So great. This is why we tell our investors, they're like, hey, what's the exit? I'm like, first of all, there's only one exit, right? Because we only have one strategy. Our strategy is to build a great American company. And so if you're building a great American company to hold, because what else would I want to sell and then buy? Like stock of all a great company that we built and we know and we understand. And we want to build a company that our kids can work at and their kids can work at. And so the only exit plan that we have is to go public. And by the way, the only way to really get bought, as you just said, is to announce you're going public. And so everybody who wants this bolt-on opportunity knows this is the last bite at the apple. We're either going to pay a high price and buy it. Otherwise, this thing is going to complete the arbitrage of getting from private to public. Now it's going to be 3 times more expensive than we can ever pay for it. And it's just a good public company.
Mm-hmm. And just to add on to that point, because this is like recent news in our industry, is that there's a lot of people in our industry, I won't say a lot, there's people who like to post on LinkedIn, which is fine, but anytime they see $1 billion exit, they think it's a great event. And in reality, when you look at the documents and the numbers, I won't mention the company names, I think I beat up on them enough, but there's one company who got acquired for, I think, $1.2, $1.3 billion. Sounds like a great thing. The problem is that by the time they went public, they had raised $700, $800 million. right? And I think at their like highest valuation was like $2 billion, but they didn't build in a variety of ways a company that became a successful company. And so they got bought in a fire sale. That's not a good story.
I want to get back to a question you asked, but my brother worked at a company and he's, hey, I'm leaving. Do you want to buy my options? Because we buy, they're in the money. I have the options at 6, you know, so we can buy them at 6 and they're in the money at 850. So we make a couple $100,000. I go, hey man, that sounds great, but I would need to get all the investment documents from every investment that's been made and build a fully diluted cap table to understand, you know, what preferences everybody has alongside our in the money shares. And then I would have to understand how much money remains to be raised, what the value of the company is, and how tight the founders or the board is going to hold the line on capital raising relative to prior valuations. First of all, if I could get the information, that exercise would take me 100 hours, which I do not have, you know, and that costs real money because I got to put my team on it. Secondly, we do not have the information rights. You're like a mid-level employee at a large tech company. You and I can walk in and we're like, hey man, we're looking for all the finance documents, you know, over the last 5 years. Do we want to go through them, have your law firm turn it over to us, and then we want to meet with the board and understand the go-forward financing strategy and what the valuation dilution, what the valuation support is, and what the data underneath the valuation support is going forward. Tell me about that. And they'd be like, no, we just go away. That's not a thing. That we come back to the same issue of you can look as an outsider at a deal and think it's good, but unless you have a fully diluted capitalization table, know what the shares are, what the rights are for the shares, and what the preferences that have been given in the full capital stack, you don't understand that deal. So what is a good deal is a question. And so I come back to, and that's what I think we do the webinar around, but the secret or the big rug pull or the takeaway is a good deal is one that you're involved with making. Nobody is going to give you a good deal. When investment banks, their job is to make a deal, build a deal out. No other investment bank is going to buy into that deal because that's what investment banks do, is they make deals. Right now, they go take that deal and they sell it to smaller investors or to retail. And so your job, if you want to win in a deal, is to be joining a group that is involved in putting the deal together. Be close to the deal being put together, because there is no way a good deal that other people put together are going to let you in at a 4x return, 8x return, 10x return. They're just going to, why would they? You have a small check size. You're an investor that is annoyance. You're probably going to ask a lot of questions, ask for reporting. You can't afford to lose the money. You know, you don't like to lose the money. You're just not a fully professional investor. So a good deal that is fully baked is you're only going to have access to it when it's like an 8% return, not when it's a 4x, 10x return. So how do you get at the 4x return deals? This is what family offices do. They look for deals that are in this air bubble, as you mentioned. There's something wrong with the deal. And you call it no man's land. In our vernacular, we call it an air bubble. There's some things wrong with it. Now, this is where the experience comes in. It's not just about finding a deal with some things wrong to it. It's finding some things wrong where you have the cards to fix it in your pocket. And so private equity group or a venture group or a family office or crazy rich guys or whatever, they see that it's a good deal, but it's just too much work for them. So the way that you get access to a good deal is by doing work. Think about it. It's the only way you're going to get in. If your only way into a deal is by writing a check, there's somebody with more money, as I said, more analytical power than you, and in the right geography. So if I can, maybe we can just talk about geography for a second.
Please.
Deals come out of ecosystems. They don't just, again, I don't want to pick on Gilbert, Arizona, or El Paso,
By all means,
Texas.
Pick on Gilbert, not
Delaware.
Not El Paso. Yeah, there you go.
So where's the next great Pandora, the next great Star Wars, the next great, what movies do you love? Cars.
You know what, as a dad, yeah, my kid's obsessed with it. Yeah, Cars, it's actually a really good movie.
Great movie. What are the movies?
You know, it's sad. Just a side note. Do you remember the last time you were excited for movie season?
I know.
It's like, you remember there was a time.
Yeah.
There was a time where like they would start rolling out next year's movies now, and you'd be like, man, like these 3 of these 5, I can't wait to see. So yeah, I can't. You know, the Planet of the Apes, pretty good. John Wick, yeah, that was good.
We had playing in here John Wick 4 when you walked in.
Oh, really?
Yes, that's what that was. So, but Star Wars, Pandora, John Wick 4, Cars, Planet of the Apes.
I'll throw some TV shows. I feel like I'm doing the movies.
Let's do it.
So, of all the ratings that are out there, what do you think was the #1 TV show based on ratings across the board? IMDb, Rotten Tomatoes, everything.
Breaking Bad.
You are correct, my friend. Right. Breaking Bad. I said Breaking Bad. Sopranos was great.
Sopranos, right? Yeah. All those things. Where do they come from? One place, Hollywood. That's it. Not from El Paso, Texas. Go Google. You know, how many Nobel Prizes and how many billion-dollar revenue movies were conceived of, shot, acted in, produced, and distributed from El Paso, Texas? None and zero. Hollywood's movies, great entertainment media properties come from Harry Potter. She wrote it, what's her name, whatever.
Oh, J.K. Rowling, yeah.
She wrote it in England. It was published there. But when they wanted to turn into a movie, did they go
Hollywood.
To Bangor, Maine?
Definitely not.
Did
they didn't do it in London.
Florida?
Nope.
Did they go to London? No, they go to Hollywood. When they decided to do a theme thing around it, where Universal Studios, that entertainment at that level happens in Hollywood. Why? That's where the actors are. That's where the girls that actors like to date are. That's where the movie cameras are. That's where the sound guys are. That's where the editing is. That's where the money is. That's where Paramount is. That's where the production studios, that's where the lots are. That's where the special effects are. And that is where the restaurants that actors like to eat at are. It's all there.
The machine is there.
The machine is there. It's an ecosystem. So if I'm investing in a Medtech deal, I go, where am I? Am I in San Diego? Oh, that's good, right? That's where the biotech is. That's where Medtech comes from. That's where the science is done. UCLA, USC, Southern California. That's where the pharmaceutical companies are. That's where the venture firms that invest in pharma are. It has a direct flight. San Diego, you can't fly direct to anywhere in the world except for San Jose, right? Because that's a direct Medtech flight on Southwest 6 times a day.
You're correct about that.
You can't get to anywhere from. Hey, you want to go to Milan, right? You can fly to Milan from San Diego for about $3,500 to $4,000, at least in the seats that I like to go in, unless you want to fly direct. That seat is $10,000, right? You just can't. But you can fly to Silicon Valley from San Diego because we have this alignment with capital for MedTech. If you're in El Paso, Texas, and I don't want to be prejudicial, you're in Newark, Delaware, and you're being offered a MedTech deal, why?
Yeah.
You're not in the ecosystem. Tattoo this on your arm. Deals come out of geographic ecosystems. So oil deals, they don't happen in Manhattan. There's not oil deals happen in El Paso, Texas. In Texas, Dallas, that's where the oil industry ecosystem is, East Texas, West Texas, and that's where the infrastructure is to fund, locate. That's where the drills are. That's where the drillmen are. That's where the surveying company, that's where the data is. That's where people know how to read the data. That's where the ports are. That's where you ship it out of, right? It's not West Hollywood is not where you run an oil company. You go through every industry like that. So are you in the ecosystem or the people who are doing the deals, so are you affiliated with the ecosystems? So deals don't just come from nowhere. They come from somewhere. So there's a way of doing basic underwriting on a deal, but the reality is, unless you are either adding, if all the deal needs is money, the likelihood, if you are out of the ecosystem and all you're doing is writing a check, that is a deal that is too high risk. So we go back to the language, you're stepping in a ring where they punch too hard. You're like, hey, it's my first UFC fight. Let's take on Nate Diaz.
Bad idea.
Just have Nate Diaz for president. One of the first things on the internet was this Al Pacino soundboard. Have you ever seen this?
The Al Pacino soundboard? No.
It's so good. We got to get it linked into this roadcaster here, the Al Pacino soundboard. But we need to get a Nate Diaz soundboard.
Oh, he fought this weekend, and his sound bites are amazing. He won, unanimously. He wants to go back to the UFC, but yeah, his sound bites are fantastic.
It's like the best sound bites in the world. But yeah, you're not going to just sign up for your first fight to fight Nate Diaz.
I'm gonna throw something, just a little curveball at you, and we'll see if it lands. You know what Nate Diaz is like a real life version of? Mo Sizlak from The Simpsons.
Oh yeah.
You can't unsee it now.
Yes. No, that's good. Yeah, we need to get those Nate Diaz one-liner soundboard. But check out the Al Pacino soundboard. It was like the
I'm gonna
first
check that out.
internet site like I ever saw. I was like, the internet is amazing.
That internet will get you though.
Yeah,
You gotta be careful.
Yeah. So the where you can play at is where the group that you're in is for sure. Like in our deal, we're doing the entire deal, the next $50 million from individuals. And so we are openly declaring that we are not going to professional capital. Or if we do, it's on our terms, right? And so so how do you know that's true? The first investors in the deal, the anchoring group in the deal that I have, are a first responder, guy gets in an ambulance, shows up, got shot, you fell off a ladder, you got in a car crash, that guy, right? Pretty clear, he's not making a ton of money like that. The guy wrote, say, $500,000 check, a lot of money for that household. He's not going, yeah, I'm a 7 to 10 year hold, keep them play this long, I'm in a long cycle, I want to get reporting once a year, let me know how the fund is going. He's going, I have an 18 to 36 month time horizon for my family money, and I want my money to come back with lots of friends. What is my return? And we go, hey, we're gonna take this company public to the best of our ability. We're gonna run the private to public market arbitrage. We're gonna get in that 36 month time horizon, we're gonna look for 20, 30, $40 million of EBITDA, and we'd like to get you a 10X on your capital as a hurdle and a threshold. And the other investor in the deal is just a real estate guy who made money, single family residence, buying and selling real estate, a Navy SEAL who's now working as like a wealth manager, but Navy SEAL. And so all those guys funded the first $5 or $6 million, about 7 of them, the first $6 million in the deal. They clearly are guys who want an exit on a short-term threshold. They're just not cashed up to have a significant part of their net worth floating around for 7 to 10 years in unknown circumstances, right? They're not even a family office. They're just guys who believe in the deal and want to return. And then we go, okay, who are the next, on top of those 7 investors, we have another 40 investors at sort of $100,000 checks. So now we got 47 people who have written $100,000 to $500,000 checks, right? And then we have another roughly 70 people on top of those who have written 25 to 200 checks. So now you're looking at 120 or 130 people who are on family timelines. Pretty clear at that point what the strategy is. You're not going to be able to change your strategy and invoke an entire shareholder base revolt. Have everything you've said online, everything you've said on investor calls, everything you've produced in your board packets, everything you've told investors up to that point categorically shift and be not true and in a different direction would cause, legal, compliance, and financial chaos. So that's how that the company is really dedicated to not taking professional capital and riding it out direct to a public listing.
And I love the way that's the first time I heard it. I'm gonna have to use that, but family timeline, which I like.
Yeah.
Because it changes it. It changes the rules and more specifically the game that you're playing.
It changes the game because when you are investing in a fund and they go, hey, we're a 5-year hold, except unless we're a 7-year hold, unless we are a 10-year hold, unless we're a 12-year hold, like it's best efforts. You're in a deal funded by individuals and you haven't mixed in professional investors and all the stuff we talked about, you're very clearly on an 8 to 48 month timeline. That is their threshold for when they want their money back, even if they just get their basis returned, but they are not, by definition, long hold investors. And they want to see that money back. They want to use it for something. They want to, right? Because why? Because families change. A family office does not change in its character. So an analyst might leave and they replace the analyst, but they still are maybe managing $40 or $50 million. Their thesis might still be 60% in real estate, 5% in tech, 15% in public securities, and 10% in commodities, whatever that adds up. So that's your thesis. So the thesis might adjust a little bit, but they're not having these like psychological, sociological, metaphysical changes within that family office. In a family, you do have that. The kids, so in your family, a 2-year-old becomes an 8-year-old. I can tell you from having a 10-year-old that was once a 2-year-old and a 4-year-old, like everything changes. So we used to play with little trucks and have little cars. Now we drive cars. He has a go-kart.
Toys
So
are more expensive, right?
Toys are more expensive. Now here's a good, let me give you a good example, because you played hockey. So when he was 4, we played hockey here in Carlsbad. So that was one cost basis. That was like $5,000 a year. And then he got on a better team, right? And that team doesn't play in Carlsbad, it plays in Poway, which is 45 minutes away. So now we have to melt down an entire car driving every day to Poway for 40 miles each way. And then now it's not $5,000, it's bigger equipment, more travel, it's melting down a car, so now moved up to $35,000. So our cash needs are different just for hockey. Now we're in 12U AA. We're traveling, going to Canada, going to Niagara Falls, going to Chicago and playing in tournaments. So now it went from $35,000 to $125,000. I'm like, it's gonna be cheaper to just buy a plane and travel to these things. Now we have an off season, so he needs to do another sport in the off season, so we're playing lacrosse. There's another $35,000. So you go from, your son goes from consuming $0 a year, a couple like little cars and some easy stuff to play with, to consuming 120. So you have a totally different family profile, and that's one kid, right? Than the things that we need a bigger house. How's it? So the economics of a family by definition change, and they want their money back to deploy it in different ways. You are not holding family money for 10 years.
Yeah, no, I completely agree. Again, within like compliance and regulatory, could you share a little bit more about the deal that you're currently raising? And for those who are listening, again, I'm lucky to have not only a lot of like great investors listening to it, but a lot of founders who got flush with cash, and it's the first time they have money. I think a lot of them, their first initial thought, and this was mine a while back as well, which is like, oh, let me go put this into a VC fund or anything, and which is fine, but that might not be the best use of your capital, especially considering the family timeline.
Yeah, we could talk about, I think when we do the webinar, I can show some charts. Like, you have to look at what VCs actually return, right? So people fetishize venture because some venture firms return a couple 100%. But if you overall look at venture as an asset class, it is not a high quality return. You're looking at but because venture produces some of those sexiest, highest profile companies in the country and in the world, Facebook, Google, Oracle, Microsoft, NVIDIA, because it can produce those companies doesn't mean it does. I'll just summarize venture. Just because the dog barks and the phone rings doesn't mean the dog barking makes the phone ring.
That's a good point.
So I can show you 20 charts that explain that in more stoichiometric calculus, but that no matter what, we'll still end up at that same thesis. So the deal that I'm in is amazing. Because of Pitch Anything and in the book, and probably you because of your podcast, I see a lot of stuff. Everybody wants me to help them raise money. I see a lot of cool deals.
I was gonna say that was one reason why I want to have you on the show. I thought it was very interesting is that because of your book and the body of work you've put out there, as a byproduct of that is you get a lot of deal flow. A lot of people try to manufacture deal flow, and then there's no reason for that deal flow to exist to begin with them. But for you, provided something of high value. I mean, look, you're coming on my show right now years after I read the book, right?
Yeah.
And so as a result, you get a lot of deal flow. Please finish what you were saying.
Because I see so many deals, I had to pick ones to work on, and I picked on ones that I thought were good. But I came to this understanding that if it got down to me, as well known as I am, and I'm well known. If I walk down the street, people stop me. I'm going down an elevator in Las Vegas. Somebody's like, oh, can you sign my copy of Pitch Anything? I'm like, why are you walking around in Las Vegas with a copy of Pitch Anything? I don't know. All that stuff happens, and it's crazy. So I'm well known. I see a lot of deals, but I started realizing, like, even if it gets down to me, that means they didn't come to me first. They went to a bunch of other people who know what they're doing, and they passed. And so I was seeing really the leftovers. So what I realized is, where is the arbitrage that I fill? What are the cards can I play in the deal that other people can't? So the deal I found that came to me, a $400 million company in Italy, came to bring their new technology. They've been doing this for 60 years, this one technology in this engineered quartz, as you see. So they own the entire market, and they thought, hey, it's just a quick snap, come over to the United States, roll out our new technology, right? And then what happened is they really had trouble entering the market. And so I looked at why. None of the reasons were the technology, none of the reasons were their know-how, none of the reasons were their experience. It's literally language, time zone, cultural understanding and understanding of the capital markets. Those things are difficult for them from Italy. Understand they're in a 9-hour different time zone. So from California, it's just everything's a pain in the butt from a timing standpoint. Number 2 is language. There's 1,000 people in the company. 999 of them speak Italian. One Indian guy. His job is to pick up the phone when India calls. That's it. It's an Italian, true, homogenous Italian manufacturing tech firm that is based in Italy, and they're just, English is not their first or second language, so they just have a language barrier. And number 3, the financial markets in Italy work totally different than the financial markets in the United States, much less California. And the last thing is sales, right? Sales is different in Italy than it is here in the US. So they ended up reading Pitch Anything and flip the script, and they're like, we got to do this stuff. And so when I looked at that deal, I'm like, now I see why they didn't get traction, because they need me, nobody else. Everybody else had to say no or whiff on it because it was just too hard. Time zone, language barrier, misunderstanding of how the capital markets work. They just wanted one person to write a $200 million check, right? They just don't understand the concept of syndication. And so I stepped in there and fixed a lot of things that I do on a day-to-day basis that was not hard for me. So I have a deal that was in stuck mode, in this dislocation, in this air bubble, and all the things they needed, I do.
So essentially, the things that most, either whether it's a venture capital firm or a banker, is too much of a headache for them to deal with, because it's just not in their wheelhouse. It's in your wheelhouse.
Correct.
And so the cards that you don't usually want to deal with are already on the table. You just had to come to the table with what you provided.
Yes.
And now you end up with a potential unicorn.
So that's what you have to ask yourself, and that's what I ask myself, is what I do so unique to this situation that it's a perfect marriage. They're stuck in the dislocation or a glitch in the capital markets where they can't raise money because they don't have all the pieces to get to the next stage. But those are pieces that I have in inventory.
It's a great point. And it's just, again, I really appreciate you having me down to the studio. I'm excited to do the webinar, but just to share this and we'll wrap things up. Even in the venture capital markets, I've spoken to 2 different VC firms where they're like blank ventures, and they told me, they're like, oh, we're changing our name. We're going to be something like capital and everything. I'm like, oh, why is that? And it's because venture is not looked on very favorably by LPs, right? Because you're taking magical guesses on PowerPoints, right? Which is fine, but it's like financial wizardry. And so that being said, even when people are moving to this part of, let's say, capital or growth stage companies, commercial stage companies, the money is a commodity, right? And this is what I always ask every investor in VC. And I'm happy that this is a part of, again, this goes back to values, right? Which is, okay, you can bring money to the table, but like, what else? So you can ensure that this deal is successful. Because money is just a commodity at this point.
Correct. Money is a commodity, and the reality is, by the time the deal that came to you, if it was a good deal, somebody else would have put it in because it is a commodity. What is missing from that deal that is a exact marriage for what you're great at? And so sometimes when I'm writing checks or whatever, and I'm just writing a check, it's a $100,000 check, I say, am I in alignment with Omar, who does, so he's adding the value, but I'm channeling through him, right? So I understand why that deal was in a dislocation, I understand what Omar is putting in precisely, and I'm riding with him, knowing that we're still playing cards and doing something in that deal that, I don't want to say fixes it, but gives it access to the next level. There's some other stuff we have to talk about, like capital markets, but what you're trying to do in investing is you're trying to take a deal that is in a one strata of the capital markets, and you're trying to move it up so the same revenue and same EBITDA is more higher valued. So the example I give is, and that's what we do with the deals. Here's an easy to understand example. If you are Harvard, if you are Stanford, and you are, say, Dartmouth, right? You have large endowments in which you put into investment groups, but your money comes with requirements. Right? So you say ESG compliant, it's not predatory lending. There's these do-goodery because you're the Harvard endowment when you're striving for do-goodery. So the number of deals that have revenue and EBITDA at the private equity level, that a firm that has taken capital from Harvard that also have do-goodery inside of them, is much lower supply of deals. So they pay more for them. So really, you're looking to work in the capital markets, supply-demand imbalance. You're trying to move your deal up into the next higher value stage of the capital markets. Maybe an even better example is a deal that has 4 years of audited financials, that has a management team whose resumes match that industry perfectly, who have done this before all the way to exit, and who have a defensible IP. Just those boxes move you into a higher quality tranche or layer of the capital markets in which you'll be more highly valued. So our job as a deal is not just to grow revenue, but is to impute quality into that deal so the revenue increases the value of it, but also the value of the company is that we're moving it up into a less supply, higher demand strata of the capital markets where people will pay more for that company.
That makes complete sense. And I think it's good for founders even to hear that, just because, again, the IP is like one box, but it's not enough. That's why I think building to last and not building to get bought will essentially, getting acquired is, I think, a byproduct of building a great company. Or I really appreciate it. Just real quick for the investors who are listening, one is, what's the homework you give to investors? I feel like one of those things is to ask yourself as an investor who's deploying a check size of 100K, maybe to $1 million or $5 million, like, what are your skill sets that you can bring to the table and help a deal forward? But what are some other things that you should ask them to reflect on?
How does money make this deal better? How does money actually make this deal better? Why can't they go do other things to accomplish the things they say they want to do with your money? So for my deal, it's big. It's very difficult for anybody to compete with because of size. We have an international partner who owns the entire market. But how does money make the deal better? We're putting equipment inside a very large building. We take raw material, we put in the back of the building, and product for which there's a size demand for goes out the front of the building. So how does this round of capital make the deal better? We're buying raw material. It buys the raw material to produce and sell into demand. It's the scaling of the commercialization of the technology. That's what the money does. So I think you got to ask yourself as homework, not can the company use money? Every company knows how to use money, right? Why can't they do there's no other way we can really get raw materials other than buy them. So that's how money makes this round in our deal better. Second thing is, does the CEO know how to raise money? I put it up on a slide. Does the CEO know how to raise money? Al Pacino plays a gangster. Because if he doesn't, your money is going to be stuck if they don't hit every single goal perfectly and they match what the capital markets needs. Then who's going to raise money? Well, if they're stuck, you're going to have to do it. So not only can they raise money, not only does your money make the deal better, and the third is, what is the likelihood that on top of your money, they're going to take more professional money? And if the likelihood is high before they're sold or go public, if the likelihood is they're like, yeah, we're going to go to private equity, if they're literally saying that today, you are going to get crushed. There's no private equity who's putting money out without a liquidation preference.
That makes sense.
So there's some other things, but those are the basic questions that you need to be asking yourself. And I think there's more like existential ones. Do I understand this business? Not, could it be the next Tesla? Like, do you understand Tesla? No, you don't. It's a complicated business. It's cars, it's electric vehicles, it's the charging stations. They got their fingers and all kinds of other stuff. You do not understand Tesla. I think you got to ask yourself, do I really, NVIDIA, do you understand NVIDIA? No, you don't. The phones use chips. Doesn't mean you understand NVIDIA. Do I understand this business?
No, I think really well said. And the last thing is that I know you're really active on Instagram and LinkedIn and everything, but where else can people like follow you, learn more? I know you have your website, OrenKlaff.com. So it's ORENKLAF.com.
Yeah.
But where else can people learn more?
Pitchanything.com.
Perfect.
So if you go to pitchanything.com, it will just take you probably to OrenKlaff.com. But I think Instagram is good. We're starting to get more vocal on Instagram.
It's great. The content is really good. And then for the investors who are interested just to stay up to date with the deals that you're working on and everything, where's the best place for them?
So I think great. That's a good sign that we have more investors than we know what to do with, is that we don't even have somewhere for them to go to on a podcast.
Perfect,
But
yeah.
I think if you go to pitchanything.com and you register, what we'll do is we'll invite you to events. This is a 10,000 square foot studio you're sitting in here.
Yeah, I missed
Yeah.
your May 30th event. I was overseas. I'm so sad. I missed. It was Cars and Capital. It was a great theme.
Oh my
but-
God, that was a great event.
Oh
so
my
we're
God.
constantly inviting you, either
Yeah.
physical event or online event that's interesting, compelling. Like, so let us know that you're around. Send me an email. We read them. Like, one of the secrets is, whether you're Grant Cardone or you're Omar or Orrin or Tony Robbins, whatever, there's really not that many people that email you at the end of the day. It used to be like, oh, I get hundreds of emails a day, when there was like Frank Kern and Tim Ferriss, Tony Robbins, right? And Tim Ferriss used to have a thing like, I get hundreds. Nobody gets hundreds of emails a day. So typically, if you just email, somebody's going to read your email and respond to you. So,
Oren, thank you so much. I'm excited to do that webinar for the audience who's been listening. Give Oren a follow. Go check him out on Instagram and also LinkedIn, especially for those of you who are reps. I know that in your spare time, you're on Instagram all the time, so go follow some high quality content. Maybe follow 1 or 2 meme pages like mine and the Mad Device Rep, but follow some more high quality content. With that said, I'm your host, Omar Khateeb. This is State of Medtech, and we'll see you all next time.
Thanks for checking out this episode. If you want to do me a big favor and join so many other people who have helped grow this podcast, take a second and look below. If you're on Apple, give us 5 stars and write a short review. If you're on Spotify, just give us 5 stars. And if you're on YouTube, hit the like button. And most importantly, if you can, subscribe. We release so many different episodes that you may miss. Be sure to subscribe and turn your notifications on. You get extra points with me if you subscribe across all 3 channels. Thank you so much. And if you felt like this episode helped you, send this to somebody who'd really enjoy and appreciate it. Share and spread the love. We'll see you all next time.